Let's talk earnings incentive. Favorite pastime.
Let me just say, earnings
of Wall Street. It's 2.5x.
Because their compensation goes up.
Wall Street's wrong again.
Welcome to this episode of the Altimetry Authority Show. I'm the Director of Research at Altimetry, Rob Spivey, and I've got my co-founder and Chief Investment Officer, Joel Littman. We thought we'd do something a little bit different this time for the Altimetry Authority Show. Joel, you just recently shot a special report, which was really near and dear to you, about the three-stock secret. And I remember when you first started pushing for this, I kind of thought it was a little different because, we've spent the last 20 years, consulting, working for billionaires, hedge fund managers, institutional investors, and individual investors on helping them understand which stocks to buy. But this it's completely orthogonal to that and completely different. Can you give everybody a little bit of a context in terms of what the story is on this?
Yeah, let me just give you an example, all right? So I have a very good friend of mine. He's a partner in one of the big four accounting consulting firms. And, a couple years ago, he called me all bragging, and he said, hey, Mr. Stock Guy. He said, I made like 60% of my money. And I said, well, on your money? Like all your money? Like we were talking about. And he said, no, I bought, it was actually Qualcomm. He goes, I bought Qualcomm. He's telling me it was a stock he bought 6-7 years ago. And he goes, I bought Qualcomm. I said, right. And he goes, and I got it right at the bottom. And I said, fantastic. And he said, and then I sold it maybe 9 months later with the 60% upside. I said, well, that's great. How much money did you put at work? And he goes, I put $200,000 at work. I said, all right, so 200 grand. So you made $120,000 on that 200 grand. He goes, yeah. I said, I think that's fantastic. I said, where'd you get the money? And he goes, what do you mean? I said, where did you get the money, the 200 grand? I mean, was it sitting in the stock market? Was it in bonds? Was it in gold? He goes, oh, it was sitting in my bank account. I go, for how long? And he said, well, it's from the bonuses I got. Well, you got that much bonus in 1 year? Or was it? He goes, no, I'd been in the bank account a few years. I go, so 4 years. Let's say 4 years. He said, yeah. And I said, all right. And then you bought Qualcomm stock with that 200 grand. Yes. You got that return. And then what happened? And he said, well, then I sold it. I go, and what'd you do with the money? And he says, I put it back in my bank account. I said, and then what? He goes, well, I've left it there. For how long? I said, he goes, this is what, 3 years ago? 4 years ago? Yeah. He says, yes. I was like, okay, hold on a second. So you're telling me that money that you got from bonus sat, right, in a cash account, a money market account, did virtually nothing, right? I don't know, you get 3%, 4%, 2%. And then you made 60% taking on an incredible amount of risk and stress, right, in one stock, and then you put it back down. And he said, yes. I said, do you know what the S&P 500 did over that same period of time if you just put it in there and did nothing? He's like, what? I said, I don't know, like 140, 150% return. So you would have got, instead of 60%, you would have had a perfectly diversified portfolio. You could have just slept every night, not even thought of anything, and you would have made a lot more money. I said, the problem you have is an asset allocation issue, right? And this is what people get caught up in. They think, instead of thinking, where should my money be in general, like should it be in equities or bonds or gold or money markets or whatever else, they get so focused on one stock idea, which I say I'm somewhat, I promote single stocks all the time, but there's a single stock that I like a lot more. That I said, there's one security you could have bought. And he was like, well, I don't know how to, do I have to buy 100 stocks instead? Or do I have to buy a bunch of mutual funds? It gets very confusing. I said, no, there's just one. There's just one. And it's the same one that my mother bought many, many, many years ago. And if you just invest in that one idea, that's your best passive income. Passive, I'll say strategy, not income, but passive strategy.
Yeah, what it says, and I think this is important, right? Because anybody who's been reading our stuff a lot knows, actually, in the background, this is not completely different from what we talk about all the time. It's really core to it. And the reason why, right, founded the firm, the reason why is because this is actually really a deeply personal story for you and comes all the way back to really the different paths your mother and father took when they thought about investing. So why don't you talk about that? Because I think that's so important for people to understand the importance of the three-stock strategy and three-stock secret.
Yeah, Rob, my father was a doctor, and this is pre-HMO days. So we're talking about the 70s and 80s where, some doctors, like he could still, he had to be making $150,000 to $200,000 a year, which back then, right, in the late 1970s, early, it's like $500,000, $600,000, $700,000 today, right, in today's dollars. And yet, my brother, my sister, and I were sharing a small one-bedroom. This is in Waterville, Maine, right? A small one-bedroom in a two-bedroom apartment where it was like almost like bunk beds. Military style in terms of we just barrack style. We didn't have any space, right? And I remember always getting hand-me-downs. I didn't think we grew up poor by any means, but I went to a public school. I wasn't going to private school, and I remember my cousins going to private schools and everything else, and my cousins. Anyway, living in big houses with their own bedrooms.
Not barrack-style sleeping.
Not this, whatever else, and I didn't understand it. And even my father would even tell my mother he wanted to do the grocery shopping, which is crazy because he was working 70-hour weeks anyway, and it's because he wanted to make sure he bought like the generic foods and she didn't overspend on groceries. And I'm like, at the time, I didn't understand what was going on. I really didn't. Why did he not have money despite how much money he was making? And what I realized years later was it could be explained by the phone calls that used to come to our house that sometimes I would answer with this sugary, sweet voice, right, where it'd be like, hey, is this Michael's son? How you doing? And I was like, I don't know who this guy is. Right? He'd be like, hey, is your dad there? And at which point I'd say, yeah, and my dad would get on the phone, and he'd be pulling out newspaper clippings, and he'd be pulling out the section newspaper with all the stock market data, because that's how you had to get your stock prices back then. And I remember him writing stuff down and everything else feverishly. And what I realized years later was that he was basically a gambling addict with the stock market, and that he lost every year all of his discretionary income anyway, above a minimal cost of living.
And he had maximized that discretionary income with that minimal cost of living.
It was terrible, right? So he had maximized the discretionary income by living so cheaply, right? And wondering where did the money go. My parents got a divorce. Look, my father was a tough guy to be around, so I was very supportive of my mom divorcing. And when my mom and he divorced, she was surprised. We were all surprised that where was the money? We thought that he must have had money stashed away. We even hired a forensic accountant to go looking, and they didn't find any money. And what we found was stock records of him losing unbelievable hundreds of thousands of dollars in any 1 or 2 year period in the stock market, chasing those brokers that were pitching him on these crazy single stock ideas. I call my father and everyone like him, right, the sheep of Wall Street. Because if you see the movie The Wolf of Wall Street, where they make those calls and how good they are at scamming people, it was my dad who was on the other end of the line. And it wasn't that he wasn't extremely bright, right? He was a pathologist. He was a very, very good doctor by all accounts. But he had FOMO, right? He had that fear of missing out, and he did not have the EQ or emotional intelligence to handle those things. And because of it, he ended up making a lot of crazy mistakes. And because of that, I got very weary. I mean, I got very worried and fearful in early years, meaning in my 20s, to be careful of single stock picking and stock analysis, especially when it's recommended by the brokerages or Wall Street or financial advisors. I thought I wanted nothing to do with it.
And I mean, but if you look at that, and because you and I have talked about this a lot, right, and how that colored when your mother went off on her own, right, obviously, as you said, with not a lot of money from your father, how you and she worked together, set herself up for success with a very, very different strategy, which is where the 3-stock strategy comes from. Can you tell us a bit about what your mother did?
Yeah, so after my father working, at the time they got divorced, after him working 20 years or whatever, and having almost nothing left. I mean, it was such a small amount of money that my mother said, what do I do with it? And in the early 90s, this is back 91, 92, 93, the evidence was already there that over long periods of time, right, the entire stock market does very well. Individual names could go up, could go down, or whatever else, but over long periods of time, the entire stock market beats gold, right? The entire stock market beats money markets. It beats T-bills. It beats any corporate bonds. It beats these 50-50, 60-40, whatever people talk about, that being 100% U.S. equities, not global, but U.S. equities, right? U.S. equities, you do very, very well over long periods of time. I think that data already was going back to like 1800, and it became obvious that what she should do.
Yeah, and just for really quick perspective, everybody, just for context on this, because I have the numbers right here. So let's just talk about if you started in 1991, right? And so stocks, right? Sorry, not 1991, 1994. Stocks, if you put $1, for every $1 you put in stocks, it'd be worth $25 now, right? So it's a 25x returns. In bonds, it'd be worth $7, a 7x return. In T-bills, and gold also a 7x return, because this has been a great period of time for gold, rare in the period of history. And T-bills basically, right, call it $2. If we go back to your point, Joel, if we go back to 1802, you started with $1 in U.S. stocks. That would now be worth $2.2 billion. $1 to 2.2
million.
To 2.2 billion. Sorry. I wish it was billion. Yes, exactly, Joel. Yeah, a million. And
That's
then
right.
bonds, that $1 would be $1,400. T-bills, $200. Gold, $4. And then obviously the dollar would be worth cents on the dollar from that. So I mean, this is what's important, Joel, to your point, is right, the idea that making sure your mom was in the right assets, the right asset allocation mattered more.
Now, it's not that every once in a while she hasn't bought a stock here or there, but she would sell a piece of the S&P 500. Mm-hmm. She'd go and buy that stock. Then whatever happened to it, she'd say whether it was good or bad. And I'm telling you, small amounts of money. She just wanted to buy some Apple because she liked Apple, right? Mm-hmm. So she does well. But when she sells it, she puts it back in the S&P 500 again. That the S&P 500 becomes your parking spot. And today, you could do that with one ticker. Mm-hmm. With one single ticker symbol, right, you can buy into the S&P 500 and get all those fantastic returns. And there's no reason that won't continue for the next 30 years. I mean, people are like, but what about the wars? I'm like, no, that includes World War I. They're like, well, what about, the Civil War in the United States? No, in the actual Civil War in the United States in the 1800s, the stock market still did very, very well during that time frame, right? As long as you have 10 to 20 years. You do very, very well with that. And that was the point. I said to my mom, I said, are you planning on retiring in a couple of years? And she still hasn't planned on retiring, right? But she says, no, she doesn't retire. And the fact is, how long your investment horizon, how long you have before you'll spend the money defines what security should be in. Not your age, not her age, not risk tolerance, not one of the most ridiculous things I've ever heard. My goodness, I can't believe it. This is for their own benefit. This is not for your benefit. Whenever someone says to you, are you a conservative investor or are you balanced or an aggressive investor? That is not for your benefit. That is so that they know how to talk to you. That doesn't, and how to sell you on doing stupid things, to be perfectly honest. Because what on earth does your emotional state, right, or does your personality have with the math of what does well and what works over time? Your emotion, my emotion, has nothing to do with what the stock market's going to do. And yet they say, oh, you're conservative, then you should do this. If you're aggressive, then you should do that. I'm like, absolutely immaterial. Absolutely immaterial. And my mother was smart. She said, well, I'm not going to need this money for a good 10 plus years. I said, if you have 10 plus years, tell me sometime in the last, and this is in the 1990s, show me sometime in the last 190 years where the stock market didn't basically beat everything. Everything, right?
Yeah, as we saw.
And so, so my mother started investing, and she just every month would put into 100% the S&P 500. Back then, you had to do it through mutual funds, but today you can do it through a single ticker, right? And that single ticker varies depending on which platform you're on, but that is why we'll say you only need 3 stocks, if you will, 3 securities to balance your entire portfolio for the long term.
And let's not bury the punchline. How did your mom do?
Oh, she's done very, very well. I mean, if you look at from her first investments back in 1991, those investments have done something like 3,400% return, 3,400% return on her very first. Now, of course, she's investing this whole time. What's amazing is that to this day, if she has a little extra money, she just puts it in the stock market. And because she still follows that, I have plenty of money to live off of. I have plenty of money, she still works actually, right? And she said, so this is money that I won't need for 10 plus years. So she still follows the exact same strategy she did literally 30 plus years ago, which made her a millionaire, right? Multi-millionaire without her having to do anything. She didn't have to, I don't think my mother ever made I don't think she ever made $100,000 a year. Sure. She was always a staff accountant. She never took a job above staff accountant. She got promotions and she was like, I don't want the promotion. They're like, well, then you're going to be working for someone else. She's like, I'd rather work for someone else than have people work for me. She just didn't want the headache. Yeah. I don't know, maybe it's because she didn't want kids anymore. After dealing with her 3 kids, she said, I had enough with managing people. So anyway, she stayed staff accountant.
Joel, you were such an easy child, though.
I actually was. I got tougher as I got older. But I was an easy kid. But at the time, she had to say what was the right asset allocation, and she followed it to a T. Now, if you need that money in less than 10 years, then there's another stock that you should get into, which is not, I call it a stock, but it's a single ticker that will deliver you performance that over time has shown a better performance over 5-6 years because there's less volatility. Yep. And then if she needs money in the next 2 years, right, next 2 to 3 years, there's yet one more ticker that you can use. And those 3 tickers, those 3 stocks, if you will, but they're 3 tickers, each of them has a different set of investments underneath, is all you really need right? For long-term, it's what every individual, every family in America, every child should be taught this in grade school. Forget about high school. By grade school, they should be taught this simple understanding. And if you learn it, you'll do very, very, very well.
And I think that's what's so important, right? Is you look at the difference between your father, right? Very, very successful in business, but because of the fact that he chose to chase the short-term highs, he basically lit all his money on fire, as opposed to saying, hey, let's start with a base of something. Your mom, who really, and I know your mom, so I've known her for, at this point, almost 30 years. It's depressing for me. It's thrilling that I've known your mom that long, but sad for me.
Better than the alternative.
That's true. But I mean, by saying, hey, let's start with a sound strategy of making sure my asset allocation is right, and starting from a framework of really budgeting thoughtfully and asset allocation thoughtfully, she could set herself up for success that she could walk out of her job that you and I know that she has today if she wanted to. She doesn't want to, but she could, because she doesn't have to worry, even though it was the tortoise versus the hare almost, in terms of what it was.
This 3-stock strategy, if you will call it, I say three tickers, right? Yeah. That get you the proper investments you need underneath that ticker, right? Is so simple. And yet you say, well, if I type in a ChatGPT, why doesn't it tell me that? Well, because ChatGPT or any AI, if you say, here's how old I am, I'm 30 years old and whatever, it's going to tell you something like, well, take 100, subtract your age, and then that's the amount you should have in equities, and the other amount should be in bonds. Or you'll just hear people say 60-40. That's just the best over long periods of time based on some math that was done in a vacuum that doesn't reflect economic reality of an individual person and the person's needs, right? And you see, the reason is because the financial advisors and a lot of these money houses, they make more money when you don't invest so simply. Mm-hmm. They want to have you in, like, your financial advisor, like, oh, I've got you in this 10 different funds, and each fund is a different strategy, and these ETFs, and you're like, is that really going to beat the one ticker that my mother bought? Is it going to? And the answer is no, it doesn't. But will it produce more fees for that financial advisor or that broker and their shop? Yes, right? What's happening to people today is exactly in the same vein. It's not quite as aggressive as what happened to my dad, because people are beginning to become a little bit more aware. But still, when people invest their money for long term in their 401ks and their IRAs and with a financial advisor, these financial advisors, right, are still putting them into all kinds of things that help the financial advisor and their shop make more money, but are not as simple as this 3-stock system, which is all anybody needs. And by the way, I'll take the Pepsi challenge with any financial advisor on this issue, because the math is behind what we're saying.
Of course. And I mean, it comes to it. I mean, you look, there's a reason why every individual investor, not every individual, but the average individual investor has underperformed the stock market all the last 5 years, most of the last 2 decades. Right? It's because of the fact that it's a combination of, one, you've got advisors pushing fee-based, right, investments that have, or actively managed things that have high fees, or just pushing them in things that are not right for their asset allocation. You've also got the issue of people who are trading in and out, like our friendly telecom consultant, who basically, because of the fact they focused on the idea of what stock to buy as opposed to making sure they're in the market, there's that whole entire...
In the market in the right way, yes.
Right. There's that rule, right? I mean, I think it's, what's the statistic? If you were out of the market for 10 days over the last 20 years, you could have basically cut your return in half.
The 10 worst days.
The 10 worst days. You cut your return in half. And it's the whole entire point is, first focus on asset allocation, making sure you're in the market, and then we can go active after that. But that's the idea.
Yes.
Right? And so, I mean, right, we talked about the actual strategy and what the 3 investments are, right? We've got, right, what we'll say is the S&P 500, right? Everyone, it's VOO if you can do Vanguard, but there's a lot of other ones which we give you in a special report. But then there's also, right, the what we call the better than cash, which is stability and yield, and then the Bankers Trust, which is a little bit more,
Bankers Reserve, we like to say.
Bankers Reserve, exactly, which is compounding. But to your point, the whole entire idea of this is really not just that it's the 3 stocks that are the secret. It's about the 3 stocks, and then you keep on talking about this idea of asset allocation. We created this framework, in Wealth Foundation, right, in this tool. Can you explain that idea of, like, 1 year? Joel will explain this, but I'm going to say 1 year, 3 year, 5 year, 10 year, and what you mean by that?
Yeah, so your age has nothing to do with where your money should be allocated with your investment funds. That is, the fact that anyone even asks your age says they know nothing. And honestly, that's one of the things you get in AI, because the problem with the AI tools is they're just looking at what the world is saying and then saying, here's what the world says. Well, if the whole world is against you as an individual investor, if Wall Street's giving you bad advice because they don't make money if you invest in these simple 3 stocks, the financial advisor can't possibly make money if you invest in just these 3 simple stocks, right? You're going to be ignoring those brokers that used to call my dad and say, oh, I've got this super hot stock for you, because you'd be like, hey, listen, my money's right where it should be. I'm not worried. I don't have a FOMO concern, right? A fear of missing out concern, because I know I've done right. That's what we're trying to offer to people, right? The same strategy that my mom has done for the last 30-something years and still continues to do to this day. And so if someone said, well, how old's your mom? I'd say irrelevant. Irrelevant, right? What matters is, will she need to spend the money in the next 2 years? And if she does, then there's a particular security that she puts her money into. Yeah. If she's going to spend the money in the next 2 to 5 plus years, call it 2 to 7, right? Yeah. That money goes in a particular security. And any money that she needs somewhere between 7 to 10 years and beyond, right? Yeah. That amount of money should be 100% in equities. Yeah. And I like VOO, the Vanguard 500. I like it because it has a cool name, VOO 500.
Which I still love that I just learned that from you 2 months ago.
Right. It's a Roman numeral 5 plus OO. So if you want to say 500 in letters, you say VOO. And that Vanguard figured that. Someone in the marketing group figured that out. But either way, it gets you into the 500 greatest U.S. companies, U.S. listed, which is important, the greatest 500 in the history of all of history. You've never had such great 500 companies, with only a handful of exceptions, right? Only a handful of exceptions. And of those 500 companies, you're already getting 40% international revenue. So if someone said to me, well, why not buy international stocks? I'm like, well, you're already getting...
Which is what Vogel used to always say. He'd say, have some international too. And it's like, well, no, in reality...
You are getting international by buying the S&P 500, because 40% of Pepsi and Coca-Cola and IBM, just add up all the companies in the U.S., they're already international revenue companies. So then the question is, do you want to get a piece of a profit of something sold, right, in the Middle East, but through a U.S. company, or do you want to have to go and buy a Middle East company that is in a country that might have questionable SEC, and I'm not picking on the Middle East, or in Southeast Asia, or wherever, where you know what the SEC says, you don't know what insider trading is legal or isn't legal, right? You don't know what the rules are around, can they dividend into one group, preferentially versus another group, or what have you, versus in the U.S. we have the U.S. SEC, right, which for all its faults that people complain about, is still the strongest securities market in the planet. And so by buying those 500, they said, well, should I buy more than VOO? I'm like, do you need more than 500 company diversification and more than the 500 greatest companies in all of history? Why would you need to?
But the point of this is the idea that if you really get into it, the goal is to own as much equities as possible, because of the fact that gives you the highest return. But it's not own only equities. And that's when that idea of, why it's the 3-stock strategy, it's, look, for the amount that you can own equities, because you do not have risk that you'll have an equity drawdown, which is what happens because within any 10-year period, we can find examples of drawdowns where equity markets did not get back to above positive and weren't the best returns over any 1-year, 3-year, 5-year, 7-year period. Any 10-year period, good luck finding something that beats U.S. equities. But within those smaller ones, we're saying, hey, look, let's figure out how much of your money you don't need for 7 years, because you should not even be cute with that. Get that in the market no matter what. Yes. But anything below that, we want to make sure we risk stratify it for your duration risk, which is what your actual issue is.
Yes.
Now, we are not the only people who talk about this strategy and who talk about the idea that there's one stock and 3 stocks, but one most important stock that, everybody should be in as much as they could. This is something that Buffett also talks about too, right?
Yeah, Buffett always says that. He had a very famous bet where he said, if I'll take a bet on something, and your bet can be on, all the hedge funds out there. The people talk about how these hedge funds make so much money, whatever else.
2006 or whatever,
right?
I remember it, yeah. Exactly.
And he said, over an X number of years, let's see which does better. My stock pick, right, or yours? And his stock pick wasn't one stock. It was the S&P 500.
And it wasn't Berkshire Hathaway, right? It was the S&P 500.
It wasn't even his own. He just said, I'm just going to make a bet that the S&P 500 is going to beat whatever you're going to put together for hedge funds. And they took the bet, and of course they lost, right? So this is, even Buffett says, when any amount of money, like when he retires, if he ever retires, or any money in his trust, or when he passes
he did just retire, so yeah, exactly.
When he passes away, whatever happens, he says, here's how I want my money managed. Then he talks about just putting in the S&P 500 also, right? Which is the same strategy. Now, he probably doesn't need as much focus on what about, because he has so much money, on what about money he might need in the next 2 years, the next 5 years, 7 years. My mother does. So my mother builds it out, and that strategy is fantastic. Now, that doesn't mean that my mom can't at times, Rob, that my mom can't say, I'm going to take something out because I want to buy a little Bitcoin.
Yes.
Right?
Yes.
Which she did.
Yeah.
And she actually did well buying it. But it was such a small piece. And the amount that she bought came out of the S&P 500. And then when she sold, it went back in the S&P 500, which is the litmus test, right? Yeah. If anyone listening right now, right, let me just say, if you've ever bought a stock and it came from your cash account, and then when you sold that stock, whether you made money or not, that's actually irrelevant. Whether you made money or not, if it went back into cash, that either meant you did not have enough money in equities in the first place, right, or you had way too much. It's one or the other, because equities goes to equities. So if you had money in the stock market and you want to move it from the S&P 500 into one stock, great. Fine, if that's where you feel comfortable, whatever. Whether or not you make money, at least you know your benchmark is, did it do as well as the S&P? And then whenever you change your idea about it and say, okay, I'm done with that stock, you put it back in the S&P. If you're going from cash to buying a stock or back again, I can tell you that for a passive investor, that is disaster. It means you have nowhere near the right. You're either taking on way too much risk, or you're so safe that you're losing massive amounts of returns in the future.
And I think we can call that not the litmus test. Perhaps we call that the Lippmann test.
No, thank you.
But so I think that does get to a really important point, though, because again, we are firm believers here in Altimetry in the idea of stock investing, though. Let's explain, because this is integral to what we talk about. How does this fit in with buying individual stocks?
So our service is, right, our initial flagship service says, first, make sure the people join us, right? And it's very inexpensive, right? And we did that on purpose. First, follow our wealth generation tools, right? Where you basically become your own financial advisor. And you say, when will I need this money? If your financial advisor isn't asking you that question, and they're just saying based on your age or based on some 50-50 or some nonsense like that, that means they're following some academia, which it's funny because I follow a bunch of academics. I do. Online, these YouTube influencers, and I like a lot of times what they have to say, but sometimes on this particular issue, they screw up so badly because they want to focus on some 100-year performance of volatility, and they say volatility is risk. I'm like, no, volatility is not risk. Volatility means it goes up and down a lot, right? But if it goes up and down a lot, but always goes up over long periods of time, that is not risk. It's only volatility, right? So investment horizon matters. And yet people still say, oh, that's just not true. And then they start quoting some crazy quantitative research that makes no sense. And all I say is, can you please look at what the stock market has done for any 10-year period, right? In the last 200 years. And with very few exceptions, it crushes everything, including gold, right? Including money markets, we'll see what happens with Bitcoin, right? We'll see what happens, because Bitcoin, from its nascent start stages, did amazingly. But so did equities, if we talk about how they did way back when. They also did that kind of return. So let's see what happens with Bitcoin now that it's maturing, right?
But so to come back to the idea of how do our idea of having stocks, individual stocks you invest in, how does that fit in also?
So once our clients have the right amount of money in a VOO or some kind of equities, and the right amount of money in the second ticker, which, right, is yield and very, very safe, lower volatility, but better than inflation. And then lastly, the money you need in the very near term, put in a very, very safe kind of banker's reserve, right? Very safe. It'll keep up with inflation. Once you have that, then we say, in our initial service also, we say, now, if you want to do better than that, right, then take 1/33, 3%, 4%, 1/25 of the amount of money that you have in equities and buy one of the stocks that we're recommending, right? And if you like 10 of the stocks we're recommending, then replace, 10 times 3%, replace 30% of your VOO with that, but at least you still have all your money that should be in the market. In the market, as opposed to sitting in cash and going, ooh, I hope that you can give me the one stock idea that does well. And I'm like, well, just think of my friend who did Qualcomm. He did very, very well, but he was misallocated for 4 or 5 years before that trade, and he was misallocated for the 3 years after that trade, right? 4 years after that trade. And so over a 8, 9, 10-year period, he lost money and I would say took on a lot of risk that who knows if he got it right on that one item versus just buying the greatest 500 companies in history.
Right, and this is the idea that, we call it in the special report that we have for this, right, the 200% stock market boost. And the idea is but each of these should never be your whole entire portfolio. Each of these should be portions, right?
Yes.
That's the whole idea of it. And so, everybody, for perspective on this isn't just a philosophy, right? I mean, there's a product behind it too. And I actually use this for a great deal of my money, and I know you do too.
Of course.
But so this is part of the reason why we wanted to come to do this, is to let you know about this special product that we have. If you want to know more, I'm going to explain what you get if you sign up for a special offer that we have for this product. But if you want to know more, you can go to the bottom of this page at 3stocksecret.com at any point. Click that. It'll take you to a landing page. It'll explain to you everything that you get. That really lands on the idea of what is everybody, what we call it the 3 Stock Secret. It's at the heart, it's really what we call our timetable investor strategy. And it really tells you about that and the other things you get. And so let me just take you through it really quick. The first thing that you get if you sign up for this special offer that we have, really speaking to the 3 Stock Secret, is you get what we call our timetable investor. Right? This is a guide each month to you that helps you understand what's going on with the market and what does that mean about how you should be allocating your money based on where you need it. What does that mean in terms of how much you put in each of the 3 stocks that we initially talk about? The second thing we give you is our Wealth Foundation tool for asset allocation. This is the actual secret weapon that allows you to figure out how much of my money actually should be in stocks versus bonds versus gold versus cash versus anything else. Because what it does, it actually helps you chart out a real thoughtful way of thinking about budgeting.
Can I say, Rob?
Yeah.
If your financial advisor, if you have one, isn't using a tool very similar to that in terms of understanding your investment horizons and then allocating your money that way, I'm just going to say right now, there's something awfully wrong with your financial advisor, at least in terms of what they're doing for you.
Mm-hmm. Exactly. And then the next is what we call the 3 Stock Secret Special Report. What this is, this takes you through the 3 stocks we're talking about, the 3 tickers, as you said, Joel.
The 3 tickers.
And it's really important. What it does is it actually tailors this to you. Depending on if you're on Schwab or you're on Vanguard or you're on E-Trade or you're anywhere else that you can think of, Merrill Lynch, et cetera, we help you understand what are the right 3 stocks for you because they're different in terms of how we make sure we can minimize the fees you're paying and maximize how much you're actually tracking what the markets that matter are doing.
There are thousands of tickers out there, literally thousands of these security tickers that you can buy into, and we sifted through all of them, and we found the exact right 3 for whatever platform you're on. So when we say it's a 3 security, it's not always. From my mom, it was 3 because based on where her money was placed in her 401k. So given your 401k or IRA, or you might be on, as Rob said, a different brokerage, different platform, we've determined what those 3 important ones are. And then once you determine through the wealth generation tool your investment horizon, right, and understand when you need to spend your money, and obviously looking at that because that may change over time. You could have a life event. You might have a baby coming soon. You might decide that you're going to work longer or work less from retirement. As those life changes change, then you change it and you modify that, what you're buying. But at least we're telling you which 3 are the best at any platform you're on, whether it's Schwab or E-Trade or Vanguard or what have you.
Right, and that's why, when we come to the Wealth Foundation tool, you always want to be updating that at least once a year to make sure you're checking.
Once a year, at least as soon as you have a life event.
Of course,
the second you're like, oh, we're surprised, we're going to have to get a bigger home because we're having another baby or whatever else, or the parents are moving in or anything like that, or parents are moving out, right? Yeah. Or you're moving out of your parents' place. Whatever it might be, right, along those lines, that changes when you'll need money, and using this wealth generation tool, it says, then here's how you maximize your returns. Because these, I just have to say again, these 60-40, 50-50, by the way, if you're in a balanced fund, if your advisor has told you put you in a balanced fund, the one thing I can tell you is you are absolutely 100% being taken, right? I have not found, and we've had clients and literally thousands of students send us in and say, what about this balanced fund? In every case, we said, yes, it is by definition balanced, but it's not balanced for you given what you told me your financial situation was.
Or target age fund or any of those kind of funds.
The target age funds, those bother me profusely also.
Could not agree.
Yes.
So those are the first 3 things that you get when you sign up for the special offer. The fourth is what we call a 200% stock market boost. So now that you've gotten your asset allocation right, as Joel mentioned, right, in our hidden alpha strategy, you might say, I want to find some stocks that I think could boost my returns even more. We've identified a set of companies that we think are the exact kind of companies, quite frankly, Joel, that you really would have said, I wish that my dad had put his money into instead of all the stuff that he was getting calls about.
Yeah.
In terms of these are the rock solid companies that still have the opportunity to have a 200% stock market boost relative to what the market is doing, that we're saying these are great companies that still have a lot of upside in case you, once you get out your asset allocation right, you want to do a little more.
And these are big blue chip names.
Exactly.
Right? I mean, this isn't like we're picking off some penny stock or something like those that has a lot of risk. You'll recognize the names that we mention when we do, and there are reasons why we say this stock should beat the S&P 500. Because for any stock that you buy individually, right, and with the 200% boost we talk about, we're literally saying take money out of what's already in the S&P if you've been properly allocated, and then go and buy the individual name. And then when we say sell, when you sell it, we don't want it going back to cash. We want it going back into the money that you've allocated for long-term performance, which is the S&P 500 again. All right?
Exactly. And then you also get hidden alpha. So for the next 12 months, you will get access to our best large cap, big company, blue chip stock recommendations that we have that we think can beat the market. And you'll get, as I said, 12 months of updates from Hidden Alpha in terms of 12 new stock recommendations, one each month, at least one each month. Sometimes we actually give more than one in Hidden Alpha. And also you'll get the Timetable Investor, and you'll get our updates for what to do with both the 200% stock market boost ideas and everything else you have for your asset allocation. You get all that and a couple other special features too, including actually one that came from a conference that both Joel, you and I presented at last year, which really takes you even more in detail about the 3-stock secret strategy. And again, I just want to say, right, this is something that Joel and I both use for a great deal of our money. And so if you want to learn more, again, go to 3stocksecret.com. You can get all of the information there, and we hope you'll follow Joel and I in this adventure and help us in terms of what we're trying to do for everybody in terms of getting everybody to the right asset allocation strategy so you can set yourself up for financial future. That
event you did, Rob, was where you talked about all the ways that financial advisors are not giving the best advice to all their clients. It reminds me of Buffett's one of Buffett's favorite books, Where Are the Customers' Yachts?
Yes.
Right? So you have all these financial advisors driving around in fancy cars and whatever, charging their clients all this money. Like, where are the clients' fancy cars? Right? Where are the customers' fancy cars? How come they didn't do well? Well, because maybe the financial advisor is biased towards securities to put you in that favor them and their firm, just like what happened to my dad versus, anyway, the event you did was a nice dissection of a lot of things, that reasons you can't trust your financial advisor, and why we launched this service, and frankly at the price point that we launched it, because we believe every American should have this strategy. Every family and individual should have this strategy at their fingertips, and because of it, we've priced it in a way that everyone literally can and get the best advice for that level of service they're getting from us.
Exactly. And so everybody, again, 3stockstrategy.com. 3stocksecret.com, and please go there, and we hope it'll help set you up for generational wealth. Thanks so much, everybody. Have a great day.
Thank you, everyone.